Welcome, subscribers, to the Saturday Summary for June 21st of 2014. As always, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illig, Executive Sales Consultant for Brokers Alliance here for The Biz. Well, this week experienced no down days for the S&P 500, the NASDAQ, and the Russell 2000, with the Dow having only one down trading day. Now on Friday, both the S&P 500 and the Dow Jones Industrial Average closed the week with record highs. As we can see here, the broad indices that we track daily all had weekly gains of over 1%, with the Russell 2000 gaining over 2% for the week. Now, as mentioned last week, remember that throughout the spring, it was the small cap stocks represented on the NASDAQ and Russell 2000 indices that were sold off. This week's results prompted Deutsche Bank to declare that the mania phase of the bull market is underway. And we all know what happens after the mania phase. We saw it in 1987, 2001, and 2008. Now, for perspective, remember that despite the record hype, the Dow Jones Industrial Average is up only 2.23% year to date, the S&P up a bit over 6%, and the Russell 2000 year to date gain is just over 2%. Well, that seems worth the risk of losing all the past few years' gains, don't you think? So, what economic miracle occurred this week to spark this market rally? Well, Fed Chair Janet Yellen, of course. At her Wednesday press conference, she stated that the Fed did not see overvaluations in assets. Of course, the FOMC, the rate-setting committee of the Fed, met this week and announced that the quantitative easing stimulus reductions will continue, with Fed asset purchases scaled back to just $35 billion per month. This statement sparked the markets, but also caused many professional market pundits to simply just deride her. Financier Wolf Richter said, and so we have a series of geniuses, Greenspan, who said that the very concept of a national housing bubble in the U.S. was impossible, just as the national housing bubble was inflating to monstrous proportions. Bernanke, who said that the consequences of subprime lending were contained, just as the consequences of subprime lending were eating up the banks from the inside out. And now Yellen, who now tells us that complacency is nothing to worry about. So we sally deeper into the Yellen era, which is the same as the Bernanke era, in that the Fed, and other central banks for that matter, is the only thing worth looking at. Central banks rule. Practically nothing else matters. Metrics and ratios are just for decoration. Markets as a means of price discovery no longer exist. Well said, Mr. Richter. Graham Summers over at Phoenix Capital Research opined that Yellen is either lying or incompetent. Well, back in the real world, the week saw the situation in Iraq fail to improve and the situation in the Ukraine worsen, prompting Morgan Stanley on Friday to issue a warning that if the price of oil continues to increase, by the way, it's at a 9-month high, that it will cause GDP growth to drop below 1%. This, while the other Fed news this week was they're lowering their second half U.S. GDP forecast by half a point to about 2.1%. By the way, they have consistently overestimated this by a long shot. Remember that the first quarter U.S. GDP was initially said was up and then was revised downward to a negative 1%. Now, does this sound like a recipe to justify record highs in the S&P and the Dow? Well, apparently so, as that's what happened on Friday. This will not end well, folks. Well, on the subject of central bank manipulation, on Friday we again saw the now predictable end of the trading week slam on the volatility index, or the VIX, reversing the negative direction of the S&P and sending it to a record close. This week it occurred at 3:30 p.m., about half an hour before the market closed. The boys at Zero Hedge are convinced that this is the U.S. Fed intervening, but there's really no proof of that. What there is now proof of is that global central banks are directly buying stocks at a rate never seen before, holding now $29 trillion in equity assets. You can see an article on page 7 of the written summary about that. Now, in the interesting but does not necessarily mean much category, check out this chart. It compares the 82 to 87 bull market to the current one. The 82 to 87 market is in the red lines here. It kind of speaks for itself. Now, on the subject of historical parallels, this leads us directly to our quotes of the week, which relate to this chart. First, listen to this quote and tell me when it might apply. One of the largest bullish factors is burgeoning worldwide liquidity thanks to expansionist monetary policies by central banks. That has helped fuel a surge of foreign investing that could propel U.S. stocks higher regardless of what happens in the American economy, some analysts say. Low interest rates also help stocks by making Treasury securities, CDs, and other interest-paying instruments less attractive. The sluggish economy, meanwhile, keeps the Federal Reserve from driving up interest rates and prevents inflation from overheating. Also, the sluggish economy, by keeping manufacturing rates low, discourages money from flowing out of financial assets into such investments as factories and machinery. Sound like something might have been written this year, but it's actually from the Los Angeles Times in 1987, a few months before the October '87 crash. Pretty interesting stuff. Well, I'll close today with this quote from Alexander Elder, a noted stock and options trading expert, who said, "This market is running on hot air and inertia. The party's still going on, but there's police lights flashing down the block and the party's about to get busted up. The longer it goes, the nastier it will fall." Well, you don't have to fall with it, though. There are safe money options available for retirees and those about to retire, and you should examine them for yourself. Don't take Ken Fisher's word on it. He clearly doesn't understand them or how we utilize them in retirement planning. Anyway, that's your Saturday summary for Saturday, June 21st of 2014. Welcome summer. Today's the summer solstice. Thank you for joining us. We look forward to seeing you next Saturday.